America used to build things. Steel mills in Pittsburgh that forged the girders for skyscrapers. Shipyards in Newport News that launched aircraft carriers. Textile factories in North Carolina that clothed half the nation. Semiconductor fabs in Silicon Valley that birthed the computer age. Chemical plants along the Gulf Coast that produced the polymers in everything you touch. These weren't just industries, they were engines of compounding innovation. Each factory floor taught thousands of workers how to solve problems. Each production line spawned incremental improvements that became breakthroughs. Each engineer trained on real manufacturing challenges went on to train 10 more. Then something changed. Not overnight, not with a single decision, but across 50 years, through a series of policy choices, financial innovations, and shifting incentives, America stopped building things and started leveraging them. The factories closed, the industries moved overseas, and the innovation that came from making things, from solving physical problems in the real world, slowly dried up. What replaced it wasn't better technology or smarter strategy. It was debt, mountains of it. Debt to finance consumption that wages couldn't cover. Debt to buy back shares and boost stock prices. Debt to acquire companies instead of building them. Debt to paper over the gap left when productive capacity disappeared. Let me show you how this happened. How innovation died not from lack of ideas but from a systematic replacement of productive investment with financial engineering. How America's elites chose extraction over creation, leverage over labor, and short-term returns over long-term capability. And why the cost of that choice is only now becoming visible. In 1950, General Electric employed 226,000 Americans. Most of them made things: turbines for power plants, locomotives for railroads, jet engines for aircraft, appliances for homes. The company spent heavily on research and development. It operated labs where scientists worked on fundamental materials science, not quarterly earnings. GE's Schenectady lab developed synthetic diamonds, improved alloys for jet engines, and advanced plasma physics. These weren't projects with immediate payoffs. They were long bets on future capability. But they worked because GE had the cash flow from manufacturing to fund them. The profits from selling turbines and engines paid for the research that would create the next generation of turbines and engines. This was the model across American industry. AT&T Bell Labs invented the transistor, the laser, and information theory. DuPont developed nylon, Teflon, and Kevlar. IBM built the computers that put men on the moon. Kodak pioneered digital photography. Xerox PARC created the graphical user interface, Ethernet, and the laser printer. The pattern was consistent. Manufacturing generated cash flow. Cash flow funded research. Research produced breakthroughs. Breakthroughs became products. Products generated more cash flow. It was a virtuous cycle. Innovation compounded, but the cycle required patience. It required companies to sacrifice short-term profits for long-term capability. It required keeping profits inside the company, reinvesting them in people, equipment, and knowledge. And it required tolerating failure because most research bets don't pay off immediately. By 1980, that patience was gone. And the man who killed it was Jack Welch. He faced a problem. GE's stock price was stagnant, shareholders were restless, and a new ideology was taking over corporate America: maximize shareholder value. The phrase came from University of Chicago economists who argued that a company's only responsibility was to increase stock prices. Everything else, worker welfare, long-term research, community stability, was secondary. Welch embraced this completely. He didn't just accept it, he weaponized it. His strategy was simple: cut anything that didn't produce immediate returns. Fire workers, close factories, sell divisions that weren't market leaders, and use the freed up capital not to build new products, but to buy back shares. Share buybacks artificially reduce the number of shares in circulation. The company's earnings get divided among fewer shares. Earnings per share go up. Stock price goes up. Executives whose compensation is tied to stock price get rich. Under Welch, GE's workforce dropped from 400,000 to 230,000 OS, not because of automation, but because of cuts. Entire divisions were sold off or shut down, and GE shifted from making things to financing things. GE Capital, the company's financial arm, grew from a small operation to the largest part of the business. By 2000, GE Capital was contributing 40% of the company's profits. GE had become a bank with some industrial operations attached. The stock price soared. Welch became the most celebrated CEO in America, and every other CEO copied the model: cut costs, buy back shares, shift to finance. The pattern spread across American industry. IBM stopped making computers and became a consulting firm. Xerox stopped innovating and became a patent troll. Kodak invented digital photography but refused to invest in it because it would cannibalize film sales. The company went bankrupt in 2012. This is the first phase of how innovation dies. You replace long-term investment with short-term extraction. You optimize for quarterly earnings instead of compounding capability, and you shift capital from production to finance. But there's a second phase, and it's darker. In 1950, if you wanted to build a factory in America, you needed capital. You could get it by retaining earnings from previous sales, or you could borrow from a bank. The bank would evaluate your business plan, assess the risk, and lend you money at interest. If your factory succeeded, you paid back the loan and kept the profits. If it failed, you defaulted, and the bank took the loss. The system was straightforward. Capital flowed to productive investment, and risk was tied to real outcomes. By 1980, that system was breaking down. Not because banks stopped lending, but because a new form of finance emerged that made lending to productive businesses obsolete. Leveraged buyouts. The mechanics are simple. A group of investors identifies a company with steady cash flow. They don't have enough money to buy it outright, so they borrow. They take out massive loans using their target company's own assets as collateral. They buy the company, then they use the company's cash flow to pay the interest on the debt. Here's the key detail. The investors put up almost no money of their own. They use debt to buy the company. Then they load that debt onto the company itself. The company now owes the money, and the investors control it. If the company thrives, they take the profits. If it fails, the company declares bankruptcy and the investors walk away. They borrowed to buy an income stream, and they extracted wealth without creating anything. The first major leveraged buyout was the 1988 purchase of RJR Nabisco by Kohlberg Kravis Roberts. KKR borrowed $25 billion to buy a company worth $31 billion. It was the largest buyout in history at the time, and it worked. RJR Nabisco's cash flow was enough to service the debt. KKR restructured the company, sold off pieces, and made billions. The model was proven. Within 10 years, leveraged buyouts became standard. Private equity firms raised funds from pension systems and university endowments. They used that capital as a down payment to borrow billions more. They bought companies, loaded them with debt, cut costs ruthlessly, and either flipped them for profit or stripped their assets and walked away. The companies themselves rarely thrived. Many went bankrupt. Toys, R Us, Sears, Payless Shoes, all destroyed by private equity leveraged buyouts. But the investors always won, because they used other people's money. They borrowed to buy income streams, and they extracted fees at every stage: management fees for running the fund, transaction fees for doing the deal, dividend payments from the acquired company, and if the company survived long enough to be sold, capital gains. The incentive structure was clear: buy companies with debt, extract as much value as quickly as possible, and move on before the debt burden crushes the business. This is the second phase of how innovation dies. Capital stops flowing to people building things and starts flowing to people leveraging things. Why risk investing in a factory that might take 10 years to pay off when you can borrow money to buy an existing company and extract cash immediately? The result was predictable. Investment in new productive capacity collapsed. In 1980, American companies invested 3.5% of GDP in new equipment, structures, and research. By 2020, that figure had dropped to 2.7%. It sounds small, but compounded over 40 years, it represents trillions in lost capability. Factories that were never built, technologies that were never developed, workers who were never trained, and the capital that didn't go into productive investment went into leverage. Corporate debt tripled from $3 trillion in 2000 to $10 trillion by 2020. But most of that borrowing didn't fund new projects. It funded buybacks, acquisitions, and dividends, money borrowed from the future to reward shareholders today. This pattern didn't happen by accident. It was driven by policy choices that made leverage cheap and production expensive. In 1971, the United States ended the Bretton Woods system. The dollar was no longer convertible to gold. This freed the Federal Reserve to create money without constraint, and for the next 50 years, the Fed used that power to push interest rates lower and lower. The federal funds rate, the rate at which banks lend to each other overnight, averaged 7% in the 1970s. It dropped to 5% in the 1990s, then 2% in the 2000s, and after the 2008 financial crisis, it went to zero for nearly a decade. Low interest rates make debt cheap. If you can borrow at 2%, it's almost free money, and the people who benefited most were the ones borrowing to leverage assets. Private equity firms financing buyouts, corporations borrowing to buy back shares, real estate developers borrowing to flip properties. The entire economy tilted toward leverage. But low interest rates punish savers. 2% interest doesn't even cover inflation. Your purchasing power erodes, and if you're a company considering building a factory, low interest rates don't help much because the returns on productive investment are uncertain and long-term. The factory might take 10 years to pay off, but leverage pays off immediately. The policy choice was clear: make borrowing cheap, and the result was equally clear. America borrowed to consume and leverage instead of investing to produce. The third phase of how innovation dies is the most insidious. It's when the people who understand how to make things retire and aren't replaced. In 1980, 20 million Americans worked in manufacturing. They weren't just factory workers. They were machinists who understood tolerances, tool and die makers who could fabricate custom parts, industrial engineers who optimized production lines, quality control inspectors who knew how to spot defects, maintenance technicians who could repair complex machinery. This was tacit knowledge. It wasn't written in textbooks. It was learned on the job, passed from experienced workers to apprentices over years. When factories closed, that knowledge disappeared. The workers retired or took jobs in other industries, and the apprentices were never trained. By 2020, manufacturing employment had fallen to 12 million. An entire generation of workers never learned how to make things. Here's why this matters. You can't rebuild capability quickly. You can't just decide to start making semiconductors or jet engines or precision machinery and hire engineers to figure it out. Those engineers need to be trained by people who've solved those problems before. They need to work on production lines where they see the gap between theory and reality. They need to spend years making mistakes and learning from them. When you lose the people who know how to make things, you lose the ability to innovate in those areas. Because innovation doesn't come from whiteboards and laboratories alone. It comes from iterative problem solving on the factory floor. The machinist who figures out a faster way to cut a part, the assembly line worker who notices a design flaw, the maintenance technician who invents a tool to fix a recurring problem. This is where incremental innovation happens, and it compounds over decades into breakthroughs. America lost this, not because workers became less capable, but because the factories where they would have learned closed, and the companies that owned those factories decided it was cheaper to manufacture overseas. The offshoring wave began in earnest in the 1990s. China joined the World Trade Organization in 2001. Tariffs dropped, and American companies rushed to move production. Nike moved shoe manufacturing to Vietnam and Indonesia. Apple moved iPhone assembly to China. Caterpillar moved excavator production to China. Ford moved parts manufacturing to Mexico. The justification was always the same. Labor is cheaper overseas. We can cut costs, shareholders win, but the real cost wasn't just wages, it was capability. When you move production overseas, you move the knowledge. The Chinese engineers who worked on iPhone production learned how to manufacture precision electronics. The Vietnamese workers who assembled Nike shoes learned advanced textile techniques. The Mexican workers who made Ford parts learned automotive supply chain management. The companies saved money in the short term, but they lost the ability to innovate in the long term. Because you can't innovate on products you don't make. If your engineers never see the factory floor, they don't understand manufacturing constraints. They design products that look good in CAD software but can't be built efficiently. And when a crisis hits, when supply chains break or geopolitical tensions rise, you're dependent on foreign production with no ability to reshore quickly. This became visible during the COVID-19 pandemic. The United States couldn't produce enough masks, ventilators, or personal protective equipment. Not because Americans lacked the knowledge to design these products, but because the factories, supply chains, and workers who knew how to make them no longer existed domestically. The capability had been offshored and couldn't be rebuilt in months. This is the third phase of how innovation dies. You lose the people who know how to make things, and once they're gone, the knowledge goes with them. Now let me show you what replaced productive investment. In 1980, American households held $1.3 trillion in debt. Most of it was mortgages. By 2020, household debt had grown to $17 trillion. Mortgages, student loans, credit cards, auto loans. The average American household owed $145,000, and wages hadn't kept pace. Real median household income, adjusted for inflation, grew only 20% from 1980 to 2020. But household debt grew 1,200%. Here's what happened. As manufacturing jobs disappeared, wages stagnated. In 1980, a single income could support a middle-class household. By 2020, 2 incomes were required just to stay even, and even that wasn't enough. Because the cost of housing, healthcare, and education had exploded. A home that cost 3 times the median income in 1980 cost 6 times the median income by 2020. College tuition increased 1,200% after inflation. Healthcare costs tripled as a share of household spending. Wages couldn't cover these costs, so Americans borrowed. They took out bigger mortgages to buy homes. They took out student loans to pay for college. They used credit cards to cover living expenses. And the financial system encouraged this, because debt is profitable for lenders. Every dollar of household debt is an asset on a bank's balance sheet. It pays interest, and as long as households keep making payments, the interest flows. The banks don't care if you ever pay off the principal. In fact, they prefer you don't. Because a loan that's paid off stops generating interest, but a loan that's continuously rolled over, refinanced, and expanded generates interest forever. The credit card industry perfected this. In 1980, credit cards were rare. By 2020, the average American had 4 credit cards and carried a balance of $6,000. At 18% interest, that's $1,080 per year in interest payments alone. Multiply that by 150 million cardholders, and you're looking at 162 billion $162 per year flowing from households to banks just in credit card interest. Add in mortgages, student loans, and auto loans, and American households pay over $1 trillion per year in interest. That's money that doesn't go toward consumption, savings, or investment. It goes to servicing debt. And most of that interest flows to financial institutions. This is the replacement system. Instead of building factories that employ workers who earn wages that support consumption, the workers go into debt, the banks collect interest, and the illusion of prosperity continues even as productive capacity declines. But here's the critical problem. Debt-fueled consumption doesn't generate compounding growth. A factory built today trains workers who build a better factory tomorrow. A loan taken today commits future income to interest payments. It's extractive, not generative. And over time, the interest burden grows until it consumes an ever larger share of income. By 2020, debt service, the percentage of household income devoted to paying interest and principal on debt, had reached 35%. That's more than a third of income just to service obligations from the past. And for many households, especially younger ones burdened with student loans, the figure was over 50%. Half of their income went to paying for things they'd already consumed, or investments that hadn't paid off. This is the economy America built to replace productive investment. An economy where growth comes not from making things but from borrowing against the future. The same pattern played out at the corporate level. In 2000, American corporations held $4 trillion in debt. By 2020, that figure had tripled to $12 trillion. And here's what's disturbing. Most of that borrowing didn't fund expansion, research, or new products. It funded share buybacks and dividends. From 2010 to 2020, S&P 500 companies spent $5.3 trillion on share buybacks. That's more than they spent on capital investment. They borrowed money at low interest rates and used it to buy their own stock. The stock price went up. Executives whose compensation was tied to stock price got rich, and the companies were left with massive debt loads and no new productive capacity. Apple, one of the most profitable companies in history, took on $100 billion in debt, not to build new factories, but to buy back shares. IBM spent $140 billion on buybacks over a decade while its revenue declined. General Electric, the company Jack Welch built into a financial empire, collapsed under the weight of debt and had to be broken into pieces. This is financial engineering replacing productive investment, and it was enabled by the Federal Reserve's policy of keeping interest rates near zero for over a decade. Borrowing was so cheap that companies borrowed not to invest but to extract value for shareholders. The result is an economy that looks healthy on the surface. Stock prices are high, corporate earnings are strong, unemployment is low. But underneath, the productive base is eroding, factories are closing, supply chains are fragile, and the capability to innovate in physical products is disappearing. When COVID hit in 2020, the cracks became visible. America couldn't produce enough medical supplies, semiconductor shortages shut down auto plants, supply chains broke, and the government response was revealing. Instead of investing in rebuilding productive capacity, the Federal Reserve cut rates again, printed trillions of dollars, and flooded financial markets with liquidity. Asset prices soared, but the shortages continued. This is the final stage of how innovation dies. You replace production with finance, you replace investment with leverage, and when the system breaks, you print money to stabilize asset prices instead of rebuilding capability. Now let me show you what this means in concrete terms. In 1980, the United States produced 50% of the world's semiconductors. These weren't low-end chips. They were cutting-edge processors designed and manufactured domestically. Intel, founded in 1968, built fabs in California, Arizona, and Oregon. The engineers who designed chips worked alongside the technicians who manufactured them. When a design didn't work in production, the problem was solved immediately. Innovation was rapid. By 2020, the United States produced 12% of the world's semiconductors, and almost none of the most advanced chips were made domestically. The most sophisticated semiconductors, the 5nm and 3nm chips that power smartphones and AI systems, are made almost exclusively in Taiwan by TSMC. Intel, once the dominant player, fell behind. Its manufacturing processes lagged. Its chips were less efficient, and it couldn't catch up. What happened? Intel stopped investing in manufacturing. From 2000 to 2020, Intel spent $140 billion on share buybacks and dividends. That's capital that could have been used to build next-generation fabs. Instead, it was returned to shareholders, and the company's manufacturing capability stagnated. Meanwhile, TSMC invested relentlessly in production. It built new fabs every 2 years. It spent heavily on research, and it maintained the tacit knowledge that comes from continuous manufacturing. By 2020, TSMC was 2 full generations ahead of Intel in process technology. The strategic implications are catastrophic. Taiwan produces 92% of the world's most advanced semiconductors. If China invades Taiwan or blockades the island, the global supply of cutting-edge chips stops. The United States has no ability to replace that production quickly. Building a new semiconductor fab takes 5 years and $20 billion. And even if you build the facility, you need trained workers who know how to operate it. Those workers don't exist in the United States anymore. They're in Taiwan. This is what happens when you replace productive investment with financial engineering. You lose capability, and once it's gone, you can't rebuild it quickly. The same pattern played out in steel, shipbuilding, machine tools, and advanced manufacturing. America once led in all of these areas. By 2020, it led in almost none, and the capabilities weren't just moved overseas. They were lost, the knowledge retired, the workers retrained for other jobs, and the next generation never learned. This is the cost of 50 years of financialization. Not just lost jobs, lost capability, lost innovation, and lost strategic independence. Now, here's what happens next. The debt can't keep growing forever. Households can't keep borrowing if wages don't rise. Corporations can't keep leveraging if interest rates go up. And the government can't keep printing money without triggering inflation or currency collapse. We're already seeing the limits. In 2022, the Federal Reserve raised interest rates aggressively to combat inflation. Within months, the stock market dropped 20%. Corporate debt became expensive to refinance. Banks that had loaded up on low-interest bonds faced insolvency, and the government's interest payments on its own debt exceeded defense spending for the first time in history. The system is fragile. It depends on constant liquidity, low interest rates, and confidence that debt will be serviced. If any of those break, the leveraged system unwinds violently. And here's the deeper problem. Even if the debt stabilizes, even if the system limps along for another decade, you can't rebuild 50 years of lost knowledge in 5 years. You can't train a generation of workers overnight. You can't restart closed factories with a policy change. Rebuilding capability requires long-term investment. It requires companies willing to sacrifice short-term profits. It requires workers trained over years. And it requires a financial system that rewards productive investment instead of leverage. None of that is in place. The incentives still favor financialization. The tax code rewards debt over equity. Corporate executives are still compensated with stock options that encourage buybacks, and private equity still raises billions to buy, leverage, and strip companies. The machine that killed innovation is still running. Here's what this means for you personally. You're living in an economy that looks prosperous but is fundamentally fragile. The stock market is high because companies buy their own shares, not because they're innovating. Housing prices are high because of debt and scarcity, not because of rising incomes. And the consumer economy is sustained by borrowing, not by productive job growth. If you're young, this means the opportunities your parents had, stable manufacturing jobs that trained you and paid middle-class wages, are mostly gone. You'll need credentials that require debt, and the jobs you'll find will likely be in service industries, healthcare, logistics, retail, that don't build compounding skills the way manufacturing jobs did. If you're older, this means the retirement you plan for depends on asset prices staying high, and those prices are sustained by leverage and Federal Reserve intervention, not by underlying productive growth. If confidence breaks, if debt becomes unsustainable, the assets you're counting on could lose value rapidly. And for everyone, this means living in a country that's less capable than it was, less able to produce what it needs, less able to innovate in physical industries, more dependent on global supply chains and foreign production, more vulnerable to disruption. This isn't about left versus right. It's not about capitalism versus socialism. It's about a specific set of policy choices and financial incentives that systematically replaced productive investment with financial extraction. And until those incentives change, until building things becomes more profitable than leveraging them, the decline will continue. The elites who drove this, the executives who chose buybacks over investment, the private equity managers who leveraged companies into bankruptcy, the policymakers who kept rates low to inflate assets, they all profited. They extracted wealth while capability eroded. And they're still in control. The system isn't broken from their perspective. It's working exactly as designed. Wealth flows upward, assets appreciate, and the productive economy, the part that actually makes things and trains people and builds capability, that's someone else's problem. But it's becoming your problem, because the fragility is increasing, the debt is growing, and the productive base that could support recovery is mostly gone. This is the story of how America replaced innovation with debt, how 50 years of financialization hollowed out industries, offshored capability, and left the economy dependent on leverage instead of production. It wasn't inevitable, it was chosen. And the people who chose it profited immensely. If you want to see the patterns before they're obvious to everyone else, subscribe. Because this isn't the end of the story. The debt trap is still tightening. The productive capacity is still declining. And the consequences are only beginning to emerge. The elites won't explain this to you. They'll tell you the economy is strong, innovation is thriving, and everything is fine. But you've seen the mechanism now. You know what was traded away. And you know who benefited. The question is what you do with that knowledge.